Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai Dazhong Public Utilities Group Co. Limited quarterly report. Shanghai Dazhong Public Utilities Group Co. Limited offers a diverse range of businesses and services. At its core, the company provides pipeline gas supply and sewage treatment activities across China. The gas and energy segment includes the sale of gas and provision of gas installation engineering services. In addition to gas-related services, the company is also involved in environmental and municipal works, including the investment, construction, and operation of domestic and industrial sewage treatment plants. This highlights its commitment to providing essential infrastructure for urban areas. The company's public infrastructure projects segment involves investments in various public projects, while its investments segment includes venture capital investments. Furthermore, Shanghai Dazhong provides transportation services, encompassing taxi services, car rentals, road passenger transport, and tour coach chartering. In terms of financial services, the company offers non-banking financial services such as financial leasing, factoring business, and asset management services. This comprehensive range of businesses and services positions Shanghai Dazhong Public Utilities Group Co. Limited as a significant player in China's public utilities sector. Shanghai Dazhong Public Utilities Group Co. Limited market capitalization of 9 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Shanghai Dazhong Public Utilities Group Co. Limited holds a significant advantage in their industry. Shanghai Dazhong Public Utilities Group Co. Limited trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 0.89 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that contribute to a company's financial performance. On the one hand, revenue growth is primarily driven by an increase in total operating revenue, cash received from sales and services, net cash flows from reinsurance business, interest income, and cash received from sales of goods and rendering of services. These factors collectively contributed to a significant increase in revenue, with some areas experiencing growth rates as high as 44% from 2025 to 2026. On the other hand, revenue decline is primarily driven by a decrease in refund of taxes and surcharges received, total operating revenue, investment income, and interest income. These factors collectively contributed to a significant decrease in revenue, with some areas experiencing declines of up to 31.5% from 2025 to 2026. The analysis highlights the importance of these key drivers in determining a company's financial performance and identifies areas where growth or decline can be attributed to specific factors. Net income decline, a shift in profitability. The net income of the company underwent a significant decline between CONE 2025 and CONE 2026. Initially, it decreased from $282,445,199.64 to $150,970,719.21, indicating a drop of over $131 million. This trend continued with an even more substantial decrease in the subsequent quarter, where net income plummeted to $16,407,168.21. The decline in profit margins can be attributed to several factors. Firstly, the company experienced a decrease in income from investments in affiliates and joint ventures. Additionally, there was an increase in loss on credit impairment, which further eroded profitability. The disposal of assets also resulted in a decrease in gain, contributing to the overall decline in profit margins. The net effect of these factors led to a significant reduction in profit margins, with other comprehensive income, net of tax, playing a substantial role in this decline. This downward trend highlights the need for the company to reassess its investment strategies and credit management practices to mitigate future losses and stabilize profitability. The company's financial performance is a positive indicator of its ability to generate cash flow. The operating cash flow for the year 2026 stands at RMB 713,533,153.39, demonstrating a significant increase in revenue generation. This is further supported by the net cash flows from operating activities, which amount to $366,623,900.09 in 2026. A closer look at the data reveals that the company's ability to generate positive operating cash flow is consistent across different periods. For instance, on page 26, it is mentioned that the net cash flows from operating activities for 2026 are plus $5,066,614.85, indicating a steady increase in revenue generation. The net increase in cash and cash equivalents of $315,601,360.44 in 2026 also suggests that the company's financial position is improving. This increase in cash reserves indicates that the company has sufficient funds to meet its short-term obligations and invest in future growth opportunities. Overall, the data suggests that the company is generating positive operating cash flow, which is a key indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, total current liabilities increased by $43.6 million, while non-current liabilities saw a mixed trend. Long-term borrowings rose by 32%, lease liabilities increased by 12%, but bonds payable decreased by 4%. On the other hand, cash paid for debt repayment surged by $870.7 million. Interestingly, despite these changes in debt levels, interest expenses showed a contradictory trend. Total interest expense actually decreased by $9.3 million from 2025 to 2026. However, financial expenses increased by $14.8 million, and interest expenses rose by 8.7% during the same period. Nevertheless, when looking at the absolute numbers, interest expenses did decrease by 13.4% from $43.5 million in 2025 to $37.7 million in 2026. Overall, while debt levels have increased in some areas and decreased in others, interest expenses have shown a mixed trend, with both increases and decreases depending on the specific metric used. The financial performance of the company's operating activities varied across different regions. In China, where the parent company Shanghai DZUG Public Utilities is based, net cash flows from operating activities saw a significant increase of 44.6%. This indicates strong financial health in this region. In contrast, other unspecified regions experienced mixed results. On one hand, there was an increase in cash received from sales of goods and rendering of services by 38.3%, suggesting growth in revenue. However, this was offset by a decrease in refund of taxes and surcharges received by 10.7% and a decrease in taxes and surcharges paid by 9.2%. These decreases may indicate inefficiencies or challenges in tax management in these regions. Overall, the performance of these regions is less clear-cut compared to China's strong showing. That concludes the financial summary for Shanghai DZUG Public Utilities Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.